Hi, everybody. Look, I'm lucky enough to have Adam from Future Step Mortgage Broking. Adam, thanks for joining me.
Absolute pleasure to be here with you, Gianni, as always.
Yeah, very good. A lot of changes over the last couple of weeks as the market starts to navigate the budget reform and tax reform. What's the sort of conversation that you've been having with clients, and what are the impacts of the tax reform that you've seen?
There's a lot of uncertainty, put it that way. I've spoken to a number of accountants, financial planners, buyers agents, clients, and everyone's unsure as to really what's going on in the background and how it's all going to affect people. It's like the dust is literally in the air, and everyone's waiting for it to settle a bit.
Yeah.
From my end, it's interesting because the budget's come out. There's obviously the impacts of negative gearing, how it's going to affect people going forwards. But the lenders have just gone, we don't care whether it's legislation or not. We're putting it into practice straight away. So when you've got people who were literally looking to buy their first investment property or extending their portfolio, and literally last week it was working, the budget comes out. And even before it's being made legislation, you got to go run back into those calculators, go take that negative gearing out of that equation, and the deal now doesn't work. And you've got to now either tip in a lot of more cash yourself or change your expectations on purchase price. That's now going to put more pressure on there should always be a pressure on asset selection. That's why I think you engage a buyer's agent, but even more so than ever now, that sort of 4.2% yield or 4% yield, when it's worked, you've got to be really trying to push north of that now almost. Yeah. And there's ones where you go, look, this is a 3.9, it's got great capital growth. That's great, but without the negative gearing aspect from a serviceability point of view, you can't get to that anymore.
Yeah.
So that's just changing conversations with everybody. And it's what's, again,
just put this closer to you, sorry.
You come back to like, why are you buying? What's the goal? What structure should you be in? Should it be, again, is it trust? Do you do an SMSF in your own name? What's the capacity looking like? Have you spoken to your financial planner around that? Have they had that detailed conversation? Is your accountant on board? Does the buyer's agent really know what your limitations are especially now these changes have gone in place? There's so many factors to it. So I think for me, it's a really case of, it's really going to highlight who the people out there who really have your best interests in mind and have got the skills and the network in place to really support you so imagine if you're investing property for the first time, you don't know all this stuff inside out. It's all right, accountants, people like myself coming onto podcasts and going, yeah, this is what negative gearing is. Most people are, how does that affect me personally? So what I do for my clients is just really show you the difference on screen. This is how the lenders look at it. Turn this off. This is the difference it makes. These are the levers you can pull. Asset selection is really critical now. And just make sure your whole team's on board and you're getting the right advice. Because if you make a few mistakes now, I've got clients right now just selling investment properties. And are you aware that the negative gearing will disappear off that? You can't buy back unless you go and buy brand new or off the plan. And have they been given that right advice? And as much as I'm not a financial planner, so I can't tell them what to do wealth creation wise, but I can give them sort of the bones of the structure and what options are available to them. But they need to get that advice from their support network and go, are we doing this the right way? And what's the end goal? So yeah, it's a tricky one. Yeah. In terms of my clients, I've been quite fortunate that everyone's just waiting to see what happens. I've said to that, I've got a couple of clients right now looking to buy. I said, just put pause on the buyer's agents. Just wait till rework the numbers.
Wait until it's legislated at least. Yeah.
Because it's a bit uncertain now. You don't want to be trapped in the wrong or signing a contract right now while this is all going through and you're like, servicing's tight and you're going to have a 14-day or 21-day finance clause in the contract. And then suddenly it looks like it works right now. But then midway through that point, they go, no, we can't service anymore. And then you're scrambling to find another lender. There's a ticking clock on your shoulder. Potential penalties if you don't. There's so many things that are going on right now where you've got to be cautious if you're literally buying right now an investment property that's established. So, yeah, my advice is just speak to your broker, and your accountant, your buyer's agent, and just go, where do we sit on all this?
Yeah.
And if you're servicing really comfortably, you're like, take that out, still works, then game on sort of thing. But yeah, it's a strange time in my opinion.
Yeah, definitely. I feel for a few sort of cohorts as well, especially those people that have been led astray over the last couple of years and been encouraged to buy inside a trust. I feel for them because of the minimum 30% tax on distributions from a trust now. And I feel for some people that are subsequent home purchases that they might be looking to upgrade as well. But at a high level, I've never been a big proponent of people that just want to accumulate property for the sake of property. Cash flow is one of the biggest pieces of analysis that you need to do at the end of the day. I often reference buying property to buying a business. When you start a business, essentially, it's likely that you'll lose money, and similar with property. but eventually you want a path out of that negative cash flow,
Yeah.
and you want the property to stand up on its own merit. I often say that a tax benefit on a poor investment is still a poor investment.
Yeah.
And a lot of people, they say, oh, I don't get negative gearing incentives anymore. I'm not going to buy property anymore. And so that leaves less of a supply in the market for renters in particular. And the only real benefit is maybe first-time buyers on the 5% deposit scheme, but
Yeah.
nobody else really, because they can't afford it.
Yeah. I have that conversation all the time with clients around negative gearing. I think sometimes it's a bit like a barbecue chat where people go down to the barbecue and they go, oh, I've got negative gearing. Oh, I want some of that.
Yeah.
So I always use the analogy, would you go and buy any business? Like, I go and buy the local butcher's that makes a loss. I don't want to invest in that. Well, why would you do that? People go, I wouldn't. Why then would you do that with a property?
Yeah.
And you can wait and say that it's negatively geared now, but it grows in value. Therefore, the wealth creation piece is there. So yeah, there's other angles to look at it. But this is again where you have to go back to your financial advisor and go, what assets are you, your financial advisor, your accountant, your advisor and broker to go, what assets are we putting into this portfolio? At what point in time are we putting them into the portfolio? What are we trying to get to? And like you said, it's not about just accumulating 20, 30 properties. What do you actually need to get to where you want to get to for a time? What's success look like for you? And it might be one property. It might be no properties. And that's totally fine as well. It could be, we need to get to 5, we want to create this outcome that's going to support generational wealth. And that's got to be mapped out appropriately. And it's like you said, you do things like buying in trust, like it works for some people, it doesn't work for others. There's reasons, there's pros and cons to all this. I think what most people are looking for is this one solution that works. And it's always a bit of a moving target. Legislation changes, rates go up and down, lender policy changes around serviceability. So some people who in trust have done really well in terms of building their portfolios up because they've had that serviceability advantages where you can exclude certain trusts, and that's allowed them to go to the next one. But again, it's like, why are you doing it? And does it match with your long-term goals, short-term goals? And is your financial advisor and accountant important? So for me, it's like if I put someone into a trust, for argument's sake, or an SMSF, I always have to say that you've got to get the advice first. I don't want to be doing it just off the back of what I'm saying, because I can technically write the loan.
Yeah.
But is it right for you to write the loan? Especially when it comes to things like SMSFs, because that's where I feel there's a lot of red tape and compliance. And I want to be putting my head on the pillow at night going, they're well looked after. So if I say you referred a client to me and say, these guys want to buy a property in an SMSF, I would look at the numbers and go, yeah, you've got the funds to do it. You've got the serviceability, you've got the income. That's great. But what of your cash in your SMSF should you be deploying into that asset? Is it 20%, 30%? I'm not a financial advisor. You need to speak to your financial advisor. What liquidity you need after the purchase? How's that going to be invested in other asset classes? Is this, if you map the trajectory of that growth of that property over the next 15, 20 years to retirement, tied in with your cash position in shares, etc., is that all going to meet your requirements? I'm not there to give that advice. That's where the financial planner goes, yes, we can do this. This makes sense. Adam, you're right. We're going to put in 20% on this for the SMSF. And that's where I get that comfort to go, you've got the right advice now. And then you can engage, say, your buyer's agents to go, we know exactly what the parameters are now, what yield we need, go search and find those assets. So yeah, the structure around individuals, negative gearing, tax, trusts, SMSF, there's always a pro and a con every time. There can be multiple pros and cons, and it won't suit everybody. So trust won't suit everybody. It will for other people, and there'll be different reasons why they're doing it. So it's clients having the ability to understand that, someone to be guided through that process by a team who are not going to bamboozle them with potential outcomes and not give them the sort of, not saying get into the nitty gritty of the specifics and how trusts are formed. You don't need to know all that stuff. It's just knowing how it fits into your bigger picture. And do you trust these guys to do all this team to really support you to achieve it and not doing it for their own sort of benefit sort of thing?
I think that I always say that there's 2 or 3 questions before you even get into what sort of property I should buy and what entity I should buy in. And that's like, you've mentioned a couple of times, what's the goal that you're trying to achieve? In particular, I find that people come to me with the property in mind or the area in mind. So what's the goal? Are you trying to create capital growth? Are you trying to create passive income? Some younger rent investors are simply just trying to accumulate wealth in property to be able to eventually buy their principal place of residence. And we've been able to do that in some cases in a few years. And so for that reason, I just say, okay, predominantly we're looking at capital growth for that reason. So we have to look at this type of property. But I often just consider myself like the stockbroker of the property world, of the real estate world. I'm not here to tell you whether trust or SMSF or company or individual is best fit for you. You've seen a financial advisor, you've seen a mortgage broker. They've told you what your capacity is and what your goal is. You've fleshed out the goal. And then I'm there to go out and have a look across the 15,000 plus suburbs across Australia, where the most area and what the most appropriate property type in that area is. And then from there, like we work out the cash flow and we meet the parameters and all that sort of stuff and model that. But by no means do we start with the property in mind, because I've had plenty of people come, it has to be in Sydney, Melbourne, or Brisbane. I'm like, no, that doesn't work like that. Yeah.
Yeah, it's a bit case of do you want to sell apples in Sydney and you make $1 an apple, or do you want to sell apples in Brisbane and you make $4 an apple? What would you prefer? Well, most people pick the Brisbane choice. So same with property, essentially. It doesn't have to be in a certain spot. And again, I always go back to when someone comes on for a discovery call, first question is, I always say to people, just tell me what's the goal, what you're trying to achieve. And you'd be surprised how many people will just very basic form go, I just want to buy my first investment, or I want to buy a home to live in. Yeah. And after that, I'll say 90% of people don't know really what the bigger goal is. And what I see from mine is I have clients come across who've got maybe portfolios of, say, 7, 8 properties. And you would think if you had no property, you'd be like, they must be so happy and they've hit their success and they're living the dream, as it were. Those people are actually quite miserable because they're either restricted in terms of the structure wasn't right at the start, the asset selection wasn't very good, and they can't either do more, or they want to buy a home to live in. They bought the first 4 or 5 properties when they were, say, single. They met somebody, wanted to buy a home to live in. Now they're maxed out in the capacity for servicing wise, and they can't do what they want to do, but they want to keep their investments, but they want to buy a home to live in. They want to keep rent. So they're not comfortable, and they've got a few assets in that portfolio who have only got sort of 3% yields, and it's like that's not really holding it up. So they've got to tip in a bit of cash themselves. They're coming off an interest-only period, and it's like, they've got cash flow worries now because their lifestyle outside of that is high, and they're looking to buy a house. It's trying to save. So it's just, when you see that from this end, you go, again, if you've got the structure right at the start, what's your anticipation of what your goals might be in the future? Not right now, but going forward, you think you're settling down something you want to buy a home to live in. Some people are very clear. Few people are very clear on that and go, no, I don't want to buy investments. I'm happy to go in stocks and shares and do them. Okay, cool. I just want a home to live in. Some people go, I'm happy to rent. I don't want to have that commitment on my shoulders of a 30-year term and working out how to pay it off. And you go, great, so I want to be a rent investor. Okay, that's fine. But most people, that's just sort of like your 5%ers on the either end. It's everyone is in the middle going, I don't really know. And I say, have you got a financial plan? They're like, no. Or, yeah, but I don't really speak to them very often. Yeah. So they don't have that real piece of advice. And that's why I think just finding those right people is just key for kids, critical, essentially. It's just so important. But yeah, it's how people to navigate, I think.
Yeah, that bit baffles me in particular as well. There's a lot of, I don't know, the fact that here in Australia we put property ownership on such a pedestal, and that you almost treat it as a status symbol. And I own 3 properties, I own 5 properties. We have many. There's people out there that own hundreds of properties, but we put it on such a pedestal. And I say, getting a mortgage is like you're chaining yourself up. And the word mortgage itself it's actually a derivation of 2 French words, which means an engagement until death. Yeah. And I'm like, well,
great.
Yeah. And
that's your tagline for your website.
Yeah. Engaged till death. Yeah. Yeah. But I just think there's nothing wrong with renting, and people in Europe and even America, they proudly rent. And I think the same thing here in Australia. I'm renting at the moment, and I won't say how much the property is worth or even what rent I pay, but the yield is just over 2%. And I'm just thinking, that's not even enough to cover expenses for if I had even 50% debt on the property, and council rates and water rates and land tax and all that sort of stuff. Like, yeah, I wouldn't invest in my house whatsoever. I feel sorry for the landlord.
Yeah, it's like investing in a big credit card. Yeah, it just does you no favour. It's just a big, massive debt. I think people say, why would you rent versus own your own home? If you want to knock walls down, and you can't do that in a rental property. So I want that flexibility. If you've got some sort of like visionary, buying something that's you're going to transform it, and you want to do it, then if you wanted to transform something property into something different, then yeah, you've got to own it essentially. But the reality is, if you're not doing that, nothing really changes. Yeah. You're still living in the same suburb, the same area, doing the same things. And yet what you've got with the rental is you haven't got the debt on it that you've got to pay off, and you're living the lifestyle like a cost. And if something goes wrong, you want to lose your job, or you want to change suburbs because the kids are moving to school, you can be out there within a few weeks almost. Flip that around. I need to sell this property now because we've lost our job, or whatever it might be, or we need to relocate. Then you've got to sell it, costs, going to buy your stamp duty, pressure, and there's a lot of flexibility with renting. So yeah, that whole sort of like dead money. Yeah. If you're sat in that house doing absolutely nothing, twiddling your fingers, then it's dead money. Yeah, because you're not enjoy. If you're living somewhere and you're enjoying the local coffee shops, the neighbours that you've got, whatever it might be, then it's not dead money. It's just it's like going to. It's like an entertainment cost, if you want to put it that way. It's like you're going out. This is what how I spend my time. I enjoy myself being in this area.
Yeah.
So, but if you're investing elsewhere, like in stocks and shares or in property, and your money's working for you elsewhere, then that's what I think people make the mistake is they go, I'm renting, but they're not doing anything else investing wise. They're not investing in property. They're not investing. So it is dead money now because you're not doing anything with it. You're not building any wealth anywhere. So it's just changing that mindset and realizing, look, if you want to live in this particular area, to go and buy this house, you've got to have $300,000 of deposit and costs. That's a lot of after-tax savings. Or you can move in next week and rent. What do you want to do? I'm going to wait somewhere else for the next 7 years on the hope that as prices keep going up, that door just gets closed and closed more. And you're like, you could have been renting that, living the lifestyle for the last, and then doing it else with your funds. But again, it's just it depends on the generation you come from. If you've got parents who never did that, my parents never invested in property, so I've had to learn this stuff later on in life and gone, damn, if I'd known that sort of years before, I would have started that way before. But and some people just don't know. So it's hopefully podcasts like this and all the ones that are out there just basically start to ask questions. Asking questions is good, but then I think the key thing is then, who do I trust to help me? I think that's the biggest thing.
Yeah.
Who's not got an incentive behind what I do from a transaction point of view? That's where you think people need the proof, and it's not easy to find. After nearly onwards for 10 years doing this now, it's not as easy to come across really solid people in their professions who you can trust 100%.
Yeah, I think on a few topics, like especially coming from an ethnic background and other ethnic backgrounds, there's always a stigma associated with renting. And it's that old adage, rent money is dead money. But if you're looking in this day and age, in some cases, the rent is less than the interest-only repayment. So that's not taking into account other expenses. And you think rent money isn't really dead money because I'm living in this house for much cheaper than what the interest bill would be. And then previously, before the internet and mass media and all that sort of stuff, your really only financial mentors would have been your parents, close friends, or family. And they probably would have all told you very similar things. Financial advisors are crooks, the share market, you'll lose all your money in the share market, all this sort of stuff. So nowadays, like now that we do have mass media and it's easier to get hold of these little golden nuggets, podcasts, short form clips, whatever, you start to not learn more, but you start to open your eyes a little bit more, and that prompts you to have a deeper conversation into that. And so I love to produce content like this because it generates these little, I call them golden nuggets of wisdom. And people take that and they're like, you know what, I do need a deeper conversation about my finances.
Yeah, I think that's a good point. But I also think as well, living where there's a lot of content as well. Yeah. I think when you go onto sort of social media, I think I said it before, like it feels like everybody is an expert. Everybody has the answer to your problem. I know how to fix it. And this is where I think that trust piece comes in, because marketing yourself as a great buyer's agent, financial advisor, accountant, mortgage, that's just part one. It's like, it's the layers behind that. Yeah, I can say to somebody, I can help you pay down your home loan within 10 years, guaranteed, done. It's like, is that feasible for everybody? Maybe not. And you can buy and say, these guys know what they're doing. I've had the conversation, I know a little bit more. You still got to find, do they have the processes in place that really support that? Do they tell you of one of these situations where it doesn't quite work out and the reasons why it doesn't work out for people? Or is it all just positive? Which is positive is good, but there's also, when you've got elements of risks involved, like stocks and shares or property, there's risk involved. You've got to make sure that you're getting both sides of the coin here and hearing how this could affect you. Yeah. And are you making a really well-informed decision? And it's not me saying, look, just get this property, just get another loan done because I'm getting paid from it by the lenders. I don't want that. I'd rather you make sure you're comfortable, because I think of you in 3 years from now, 5 years ago, why I'm in the situation right now? Because I spoke to my broker, my financial advisor, and I agreed to this scenario. So whilst it's good, there's a lot of content. My sort of point is that just don't listen to everybody. Yeah. Because you might have, just for argument's sake, a broker's been doing it for 9 months and goes, I need to get leads in. So he's online telling you about how to accumulate like that. He might have good knowledge. I'm not saying it's not invalid, but there's still experience involved. And has he built a network around him? And you as the sort of the listener have got to go, okay, there's some valid points there, but don't take it as verbatim. Go, let me just come and question what he said, and get 3 trigger points of 3 brokers and 3. Does it all start to make sense? And they're all talking the same language, and then from there you start to go, you know what, I really trust him. The way he delivered that information to me is different to how everyone else did it. And that's where I feel comfortable that person making decisions for me or guiding me down this particular path. So yeah, that'll be my take on the sort of social media side of it.
Yeah. Look, I think social media is good and bad. I think it's good just to open your eyes and get you to understand what potential there is out there, but then always speak to a financial professional about how it pertains to your specific situation. I see a ton of influencers lately and they say, invest in ETFs and this is how I bought my first property, but it doesn't mean that should apply to you. And I was like, well, who are you to give that? Like, ETFs are specific product advice as well. Like,
Yeah.
I'm saying, like, well, who are you to tell me to invest in ETFs or buy crypto or whatever it is? That might not be anywhere near your goal, or you might be in a worse situation as a result of making those choices. It's everything. The goal is at the forefront of everything you do. What's the goal and why is this the right strategy should be the first question that everybody asks when they're entering into any investment strategy.
Yeah, 100%. I can't agree more. That's why for me, like with my clients, I've always taken that approach. The goal before the transaction, structure before writing anything, make sure the client is fully aware. Even before I hit that button, and we're going to lodge this to a particular, not approved yet, but just before we lodge, do you understand these are all things you're going to get and not going to get? Because you have these conversations over a matter of weeks sometimes. People forget what they thought they were going to get initially and what they decided not they didn't want. So just refreshing all that is key. It's difficult for people to navigate all this.
Yeah.
And nobody wants to really admit. No one goes and comes and says, I don't really know a lot, to be honest, and I'm naive to all this. No one really ever says that. They just nod and grin. If you've got someone who's quite a bolshy sort of buyer's agent or a broker or accountant, you can get railroaded into decisions that you don't really understand, don't really want. And you think, oh, they must know what they're doing because they're an accountant or you've been doing this for the last 8 years. So it's not always the case. Again, it's a case of also, again, making sure that the people that you have around you fully trust them. And I think that's through testing them through what's the risks involved here.
Yeah.
Why shouldn't I do this? And see what they say. And then if they say there's no risk, like a bit of a red flag. There's always a risk involved. And again, it's how you articulate, how the broker, the accountant, the buyer's agent articulate those risks and go, do you feel informed to go, yeah, that's the right path for me? That's where I think it needs to lean to.
Yeah. Yeah. And look, a lot of the strategies on that point, they won't meet the person's risk tolerance or risk profile. So look, in some of the capital cities, it might be more risky at the moment because we're sitting on that sort of affordability line where some areas are unaffordable. And I tell people that there's risk involved in buying in Sydney because people look at the last 20 years and they think, oh, Sydney's gone up over the last 20 years. Therefore, it will continue to go up. But I'm saying to people, there's people struggling at the moment. They can't afford their home. And it's likely that we'll see a bit of a dip in property prices over the next year or two because of inflation, because of affordability, because of interest rate rises, a number of different topics. Do you still want to invest in Sydney, Melbourne, Brisbane? Or even if your property was to go down 5%, 10%, would you sleep at night? Is that something that you can tolerate? Or even sequencing risk, timing risk. Like people that want to buy a property 3 to 5 years before retirement. I'm saying, if that property goes down, is that going to affect your retirement benefit? So there's a ton of risk that people need to be made aware of. There's no risk-free investments out there.
No.
There's none.
And like I said, you just hit the nail on the head. You say 3 years from retirement, do you buy an investment? If it affects you're asking the question, will this affect your ability in retirement or your finances in retirement? Now, you've got to think how many other people out there will go, I don't care, and just go and get the property and just get paid to get the commissions.
Yeah.
And you feel like you're doing the right thing because you're buying investments. It's for my future, but is it always the right decisions? Like you just said, like you need people like yourself who can just say it's actually right for you. This actually might benefit me. It's same with me writing loans. This will benefit me to write a loan for you right now. I don't want to write that loan for you. And you can go down the road and speak to a high street broker who will do it for you. And you might, but I want to make sure my head's on that pillow at night going, I've given you the right advice. I'm not just trying to smash this deal through to get it over the line. And that's where for me, it's like, in the brokerage, it's all about sort of accolades. If you're really quick, you must know what you're doing. It's like, speed isn't always the key. Someone's taking stock of where you're at and giving people time to think and taking the time for, even as you as the professional, the broker or the accountant, to go, is this actually the right structure for this person? Let me map it out, spend a bit of time on it. So I always have that analogy of it's like walking into a doctor's surgery and going, I've got this pain in my stomach, what is it? I can stand and tell you right now what it is, have a guess. Would you want that from your doctor? Or do you want someone to say, let me do some tests, let me come back to you, research it. And if I need to deep dive in further, we will. That's how I see writing loans and having able to buy properties and refinance and structure and buying trusts or whatever. It's like, it's a deep dive into can you physically do it from a numbers perspective? Does it tie in to your overall plan? And have you got the right people giving the right sort of advice around that? And then when they come out of that, and this is why I feel my clients, they're very sticky because they've got that from the get-go. There's been no pressure to move these deals. Come on, we need to get you to sign this straight away. So I think if you're going through that, if you've got anyone who's trying to push speed on you, then that's, again, to me, is a bit of an amber flag. Sometimes you need a bit of speed, don't get me wrong. But it's not saying you've got to all just be plodding along at snail pace. But when you've got bigger pictures going on and around your wealth creation piece, then I think you need that time to assess. And I always say to clients that don't come to me when you want to buy a house. Come to me 9 months before that and let's plan it and see where the numbers sit and start really getting to and there's no cost to doing that. So, but you having that insight will give you so much more value to make better decisions. So you've got to start seeing, like say, the mortgage broker is more not a financial planner, but like just so when you start planning the lending side of it really early on with, even if it's like a year away, at least I know what my targets are. And then that's where you start to really get that sort of value from these pressures, as opposed to met a mortgage broker, wrote the loan yesterday, it's good. Being done with a particular lender, and I got the house.
Yeah.
Okay, great. Now what? You want to avoid that, in my opinion.
Yeah. And I tell people, like, that's the difference between any mortgage broker and a good mortgage broker. Is that, like, any mortgage broker can write you a debt because at the end of the day, they're incentivized by the amount of money that they borrow. But a good mortgage broker will help you use debt to achieve your goals. Because for a lot of people, yes, the goal is to buy a house, but then the next goal is to plan to, okay, how do we pay that off? And having worked with your clients, I know that you're meeting with them every 6 months to say, okay, let's do a rate review. Even though we might not be refinancing, we can put pressure on the lender, check the LVR to get a better rate, reduce the fee, whatever it is. The next goal after you purchase your owner-occupied home is to pay it off, obviously, and especially before retirement. And that can be said of any other financial service professional. It's like, not that you enter me into an investment, but you help me use that investment to achieve my goals at the end of the day. I think that's the most important thing.
Yeah, 100%. Yeah, I can't disagree with any of that. It's just that's very valid. Like it's at the moment, it's a very much a changing landscape.
Yeah.
Serviceability is just getting harder. Interest rates have been continuing going up, it seems. That doesn't help anybody. And you've got to be on sort of on your toes with just even just moving interest rates. You've got to be on your toes with that. Now you've got this whole negative gearing component coming in. You've got to be really nimble. So if you're out there as a sort of, and especially as a new investor, just be really mindful of what you're signing on to and who's supporting you. And timing right now is critical because if you've got in-flight applications, you don't want to get caught where you suddenly can't get the deal across the line. You don't, because you say your broker was pushing it to the limit anyway, servicing by $100 a month, that deal can fall over very quickly. So you've got to make sure you've got those finance clauses in place. You know those timings as well. The broker's onto it, the solicitor's onto it, because if you make a few mistakes, again, it's costing you quite dearly. And nobody wants to go through that sort of scenario. So just make sure, because again, you can write a pre-approval and put it in, and just a broker can just see you later when you're ready to send in the contract, whatever it might be. But you want someone looking at that sort of stuff in the background. And again, I've just got a client right now, it's the same thing. They're looking to buy an investment property. They've got buyer's agents in place already. They're doing their search. And I just sent an email saying, if you might want to put it on pause for a little bit until we speak again, because I've just turned off the negative gearing now. And it would mean you have to put in another $100,000 of your own cash to fund that same property. So just be mindful before you go signing anything. And if I didn't do that, then that person goes and signs the contract 14 days, and it's a panic and a stressful time for that person. So you need to be across it, from all angles, really.
Yeah, 100%. It's a changing time. We're in a bit of a flux period, I think, where we'll move from one market to the other. And it might be a bit of a period. I reckon over the next 12 months, there will be a little bit of volatility, I'll say. A little bit of uncertainty, volatility, but definitely a bit of uncertainty until things are legislated as well.
Yeah. And look, at the end of the day, property's not going anywhere, and it'll always be, it's the only sort of asset you can really leverage. People need property. Long term, you've got to say, it's always going to pretty much grow in value. It's just a case of dealing with the cards that are in front of you right now, planning accordingly, and just getting the right advice. And if you do that property is a very good asset class to go into. Again, I think, as I said at the very start, it's just a case of really honing in now on who's there to support you. And if you've got that full trust in them, that's where you need to get the comfort from. So that's my sort of my take on it. And just quickly, when my alarm went off earlier on, so what I've on a private note, it's because I sit at the laptop quite a lot each day. I have an alarm every hour, and every hour I get up and do 10 squats. So it's meant to be equivalent to doing sort of like a 15-minute walk, apparently, doing
Oh,
10
wow.
squats. To anyone out there who's sat in front of their desk for too long, set an alarm,
Yeah.
do your 10 squats every hour, say 6 times a day. Apparently it's meant to be really good for your cognitive function and your body, and I highly recommend it.
Oh, I have to get it. I've got a push-up challenge coming up for Lifeline.
Yes.
So yeah, Lifeline are doing a push-up challenge. I'm going to swap the squats for push-ups.
Okay, yeah. So what is the challenge?
It's 3,307 push-ups in the space of 24 days. It works out to be about 145 push-ups a day.
Jeez.
Yeah.
So you're going to break that down into segments, like tens and...
So yeah, morning, lunch, and evening, I'll do 45 push-ups. So I'm thinking of breaking up into 6 sets of 8, so I can leave a little bit of a buffer.
Yeah, well, you'll come out with a big buffer on your chest.
Yeah.
Very strong.
Oh,
that's good. That's good.
Yeah, so no, looking forward to that. Raising some money for a worthy cause. But Adam, thank you so much for coming out. I really appreciate you having a chat. I think I could speak to you all day, but battery will die.
Nice one. Appreciate it, mate.